Okay. Uh, that was a very nice introduction, and I'm deeply grateful for it. But I can't summarize the entire day. This is way beyond my skill level. But I have a really good excuse. First, we had some great panelists, and I think we can say that the panelists were pretty clear, right? I don't think that, you know, sometimes when people speak, you're not quite sure what they're trying to say. I don't think we had that problem today. Sometimes also there's another problem in that only one side of the debate is presented, and it's really important that someone get up and present the other side before you go away with the wrong ideas. I don't think we had that problem today. Third is that sometimes the panels are all over the place, and you have moderators that are completely incapable of keeping the panels under control and channeling them onto a topic. And so at the end of the panel, you have absolutely no idea what they were all talking about. But we didn't have that problem today, right? So all the usual problems which someone like me is supposed to correct weren't there. So, all right, so then what is there for me to do? Well, two things, obviously, right? One, keep it short, because it's been a long day. You guys have been incredibly patient. I've been watching, as was noted, and I can't believe the level of attention that you've had over the course of a very long day, which I might point out is a Saturday, which is not a day when normally people pay attention to anything, right? Except if there's cricket. So, all right, so first I'll keep it short. The second thing is that I guess what's left for me to do is to try and answer the question, right? There's a question there, and somebody needs to answer it. So, well, I can't say I raised my hand. I was just told to do it. Now, if I look at that, I see actually two questions there. I see India's strong performer. That's one question. And if you're me, you see a second question. Turbulent world? Question mark on that one. All right? So I started a little bit in the morning about turbulent world. So let me repeat what I said. Right? And I think this is really actually important if you're a foreign exchange trader, as I know many of you are. Right? Everything depends on how you're looking at the world. If you're looking at the world the way so many people do, which is to say the mid-2000s were the norm, that's the way things should be, and we've got to get back to that, right? Then what you're going to see is year after year after year, like all these forecasters, and by the way, the IMF is included in this, of course, right? Every year you project, well, this year is horrible, next year is going to be better. We heard it from some of the panelists, right? Why next year is going to be better, they don't really explain. But they're confident. They're confident. You know, in 3 quarters, they can put numbers on this. 3 quarters, maybe 3.5 quarters, right? You know, private investment is going to turn up by 10%, right? How do they know that? Nobody knows, right? If you're one of these people who kind of buy that view that we were there and we're here, so definitely we're going back up, and it's just a question of timing, and you ask some guy to put some numbers on it, right? If you believe that, then you're going to see the world as turbulent. Because otherwise, how can you explain the fact that we're not going back up there? Right? Well, obviously, there must be a lot of bad things happening in the world, right? And, of course, at any given time, there are bad things happening and good things happening. I was very happy that one of the panelists started to point out some of the good things that are actually happening in the world today, right? Now, you can always find bad things, and then you can always use them as your explanation for why we're not getting back up there. Now, all right, where's the trading idea in all of this? The trading idea in all of this is very simple. This has been the dominant paradigm all over the world, of central banks all over the world. We're heading back up there, and there are these problems that are preventing us. And therefore, our policy has to be pump out that liquidity, push down the interest rates until we get back up there, right? Now, as time goes on, people like me, but I'm not the only one, people are starting to doubt this. And they're saying, are you so sure about this? Now, and a debate has started. It's just actually beginning. So you may not be aware of it. But believe me, over the next year, you're going to see this more and more. Because if you take a different view, if you take the view that I hold, which is that for the next few years, we're going to be going like this, then you have a very, very different policy strategy. You say, oh, all right, I don't have to press so hard on the accelerator. This is kind of where we are. And you can say things like, for example, in the US, all right, the US is growing at 2% with, say, 1% inflation, that's nominal growth of 3, and if you say that interest rates should be roughly around nominal growth, then you have interest rates of 3, and you start normalizing the Fed funds rate, right? What's going to happen to the yield curve? What's going to happen to the yield curve in this situation is the yield curve is going to flatten. Why? Because at the short end, they're going to be raising rates, and at the long end, people are going to say, well, growth isn't coming back, so long-term rates go down. Right? The yield curve flattens. So under the first hypothesis, right, of the view of the world, you have a very steep yield curve. 0 up front, and eventually you're going to go back up. If you start changing your view of things, the yield curve shifts radically. And that has market implications, which I'll leave you to work out. Right? I just want to point that out to you. That's the market implications of the kind of stuff I was talking this morning, right? This is my answer. Are we in a turbulent world? Actually, there's a debate about this, and the debate's going to be settled. And then there's going to be policy implications, which are going to have market implications. All right. Now, let me get to the question, India's strong performer. Well, people express many views. I'm going to give you several ways to look at this issue. Right? You can look at things from a long-term perspective, and you can say, well, somebody pointed out, Rajaswari pointed out, I think, India is the fastest growing large economy in the world. Well, all right, that depends on the accuracy of the GDP numbers. One can say still, with a very high degree of confidence, that India is one of the fastest growing countries, right? The point I want to make to you is the long-term view, which is that this has actually been true for a very long time. Rajaswari actually had the numbers in her presentation. What does this mean? This means that on a long-term trend path, and even if the growth trajectory doesn't change, even if growth doesn't accelerate to where it was in the mid-2000s, even if it kind of stays at this level, India is going to be catching up to the advanced countries, right? So this is in that sense, India is indeed a strong performer. It's one of the countries that is catching up. And that's the future of India. And it's a glorious future that all of us has to look forward to, despite all the million problems that we've raised and we continue to raise and we continue to feel. There's still a fantastic future ahead of us. Right? There's a second way in which India is a really strong performer that we really need to keep in our minds and in our hearts, especially when we, and that's this sort of short-term cyclical perspective, right? If you go back to the boom times, there was an amazing development in India, and that growth was powered by two things. Growth was powered by fantastic investment boom, but it was also powered by an export boom. Over this course, so at the peak, India was growing at around 10%. What was amazing, which is a phenomenal rate of growth, right? What's amazing was that exports were growing even faster. From roughly 2000 to 2010, the share of exports in GDP doubled to 22% of GDP. It's an absolutely phenomenal achievement. And it's not just like quantitative achievement, it is a qualitative achievement. Because in that decade, India changed from being one of the more closed economies of the world to being one of the more open economies of the world. It was a phenomenal change in the nature of India. One of the things, now I said also there's a short-term perspective. What does this long-term development have to do with the short-term perspective? What it has to do with the short-term perspective is, look, whatever the growth rate actually is, right? That growth rate is a fantastically credible growth rate when you think that nowadays exports aren't growing. There's very little outside demand for India's product, and yet India's growing at a very credible growth rate at a time when there's very little demand for a quarter of the products that India produces, a fifth, say, quarter, right? That's actually a really, I mean, if you're a company and, a fifth of your product line is not doing well at all, it's stagnating, and still you're getting one of the best growth performances in the industry, that's pretty good, right? So in that second sense, so on a long-term view, there's reasons for optimism. On a short-term view, India's doing not too badly considering there's very little export demand. But there are other views, right? And the big view, it was already mentioned today, is that if you evaluate things in terms of India's potential, that's where you have to say India is not a strong performer, right? We all know in our minds and our hearts, India can do a whole lot better than it's doing right now. Right? Now, I want to talk about two problems, one of which I've mentioned before, and one of which hasn't been mentioned at all today, and then I'll finish. The one that nobody has mentioned at all today is actually the fiscal problem. This may sound very strange to your ears because nobody really talks about any fiscal problem anymore. But actually there is a bit of one. If you're a company, you need to, a basic metric is to calculate your interest coverage ratio, right? Are you generating enough EBITDA to pay the interest on your debt? You can apply that same thinking to the Indian government. The metric that's similar to EBITDA is known as the primary balance, which is basically the deficit excluding the interest payments. So in most countries, what you have is you have a primary surplus. That is to say, your primary balance is positive, and you use that surplus to pay the interest on your debt. In India's case, that primary balance is and basically always has been negative. The government doesn't raise enough revenues to net of expenditures to cover the interest on the debt. Or to put it another way, the government has to borrow to pay the interest on its debt. Right? Now, people don't focus on this, but it's a fact, and it's been a fact for the past 30 years or so. Now, why don't people focus on this? Why isn't, well, the answer is because the debt's not exploding. Why isn't the debt exploding? The debt's not exploding because of two things. What happens to your debt depends not just on your primary balance, but it depends on the interest that you pay on the debt and the growth rate of the economy, right? And this balance, this difference between the interest rate, call it R, and the growth rate of the economy, call it G, this R minus G has been negative. So in other words, the economy has been growing very, very rapidly, so that even if interest is piling up on the debt ratio has been held constant because the interest on the debt has been less than the growth rate. Now, what's been happening is that as inflation has come down and real growth has come down, nominal growth has really come down much faster than interest rates have come down, which means there has to be some adjustment to the primary balance in order to prevent the situation from worsening. And if we're in a situation, then I go back to the first point, where interest rates start rising in the rest of the world and interest rates start rising here, then the situation can get more tricky. Now, one of the things that we know is that Harsh made this point, that problems aren't solved until they turn into crises. This is not something we want solved in terms of crises. This is going to have to be something that's addressed in the FRBM that's being reviewed right now. So we've taken a kind of break from FRBM. You know, in the 1990s we worried about it. 2000s things looked under control. We're going to have to come back to this. And I just want you to sort of note that. Not that anything needs to be done tomorrow, but at some point this problem needs to be tackled. Let me go to the second point. The second point is, of course, the NPA problem, which I started talking about in the morning. So I can be fairly brief here. The point that I want to stress here is that it's taken a very, very long time, 6 years, and the problem is still not getting solved. Other countries were able to solve it a whole lot faster. So you have to ask the question, why is it taking so long here? Well, there's several reasons, some of which I alluded to in the morning. One is that high inflation was eating away at the debt. And so even though nothing was being done, somehow the problem was being taken care of. But that high inflation has gone away. And we're in a situation where it's become harder for the stress companies to pay their debts. And the situation then becomes much harder for the banks. Because look at the situation in the banks now. What they're trying to do is they've got large portions of their lending book where their borrowers have turned bad. So they need to keep interest rates high, in effect, to tax the good borrowers so that they can compensate for the fact that the bad borrowers aren't paying. The problem is that the good borrowers have an option. They don't have to, if the banks keep interest rates too high, they don't have to borrow from the banks. The best borrowers can go to the bond market, and you see that happening. So the banks are getting squeezed, right? The good borrowers are exiting. They're being left with bad borrowers, and that's one reason why credit growth is so low. Credit growth industry is so low because banks don't know what to do. This squeeze on the banking system is just going to intensify, and it's going to continue to take a toll on the economy unless we do something about it. So, although we've been able to get away for quite some time with sort of playing a game of extend and pretend and hoping that something turns up or hoping that inflation eats away the value of the debt, we're getting to the point where this is going to be harder and harder. There's not going to be a crisis. There's not going to be a crisis at all, but we're going to see the problems in growth, as indeed we have. In the last GDP numbers, we saw that investment growth turned negative. So I would say, if you sort of look at the top, India is very complex. India is multi-layered. If you look at the top, in some respects, things are very encouraging, and India is doing very well. But there are problems at the bottom, and not all problems have to be solved. I mean, for all of us every day, right? We all have problems. The maid doesn't turn up for work. Traffic is terrible. There's some power cut. There are many, many problems, and most of them we don't solve, and we just deal with them and just move on. But I think these are two issues that really do need to be solved before India before we can really say that India is truly a strong performer. So, having answered the question, I shall leave it there, and thank you very much.
Thank you so much, Josh, and very well articulated perspective to look at the things. That possibility will even alter the question that we have put up. It will change even the title of the workshop. So thank you so much for giving that view and extraordinary efforts put in to articulate your thoughts. So really appreciate. Thank you so much for spending your time with us. Thank you.